Let's continue on with our market recap. As I mentioned, this day was, good, okay, or not so good, depending on what chart you were looking at, right? And what your benchmark is, what your main thing. If you're looking at small caps, we were up over 2% today. It was a pretty decent day. A continued follow through day with sectors like energy and materials, which were sort of overrepresented in the small cap index versus others, versus, the S&P doing just fine. The NASDAQ 100 down 1/3% on the same day. So we have this continued rotation away from the growthy stuff into more of the value-y stuff. To summarize, we're going to look at a series of charts that sort of make that case and explain what's going on. Let's check in on some of the other markets very quickly before we do that, though. Looking at other asset classes, bond prices up just a skosh. That was so the TLT was down in the morning and finished up higher. This is pushing 10-year yields back down toward the 1.5% mark. Oil prices continue higher, gold, precious metals continuing higher, copper sort of flat. So for the most part, commodities continuing their long-term uptrend, I would argue. Cryptocurrencies pretty choppy, as always. Bitcoin finishing in the positive, but most of the other top 10 that we follow by market cap actually finished in the red. So continued choppiness there. I want to start with just a short-term chart looking at the last 5 days. And we have the Dow in purple, we have the S&P in black, and we have the NASDAQ in pink at the bottom. And you can see what happened today, right? This is starting about a week ago. And again, it's showing you the percent changes from the starting point to where we're at. The percent changes are less what I'm curious about, and more just to show the direction on a couple of days. If you look at yesterday, sort of everything up, right? NASDAQ bouncing up pretty good. This is when a lot of growthy technology funds had one of their best days, some of their best days ever. When you have the NASDAQ turning up, from a relative weak point to a quick turn to the left and bouncing to a new swing high. And you can see that all three of these were up together. That's sort of what a normal market usually feels like, where you have these three indexes up together, and it's just which group is leading, right? So you had them all down last Wednesday, all up last Thursday. But look at what happened on Friday, right? You had this big dispersion. You had the Dow up on the day, the S&P a little bit down, and the NASDAQ a lot down. You had kind of a similar thing today. The S&P sort of a little bit up, the Dow a lot up, and the NASDAQ a little bit down. So this illustration is where there's a disconnection between those indexes, right? The exposure that these different indexes have. If you have exposure to technology, you're struggling overall. If you have exposure to energy and financials and those things that have been leadership and industrials, you're doing just fine. And the S&P sort of caught in the middle, right? And so, depending on what you think about what your portfolio looks like, if your portfolio is very growth oriented, some of these days are going to feel a lot more painful than if it's more conservative, if it's more not necessarily conservative, but more leaning into the leadership of recent months, right? That's what's continuing to work. So your portfolio could look very different depending on what sort of bets you have and how you're allocated right about now. So it is not just, I would argue, an equity decision. Am I in or out of equities? Where you're at, what bets you're making, are certainly giving you a very different return profile right now. Let's look at the S&P 500. So as we've talked about, I think we're still very much in a market in transition. It's been a nice bounce of a couple of days. There's no denying that. Yesterday, we traded up to this trend line using the recent swing highs. This is pretty short term, looking at the peaks from the last couple of weeks. We closed above that today. So now I think we're testing this swing high sort of from the end of February, beginning of March. That's sort of where we're at, just above 3,900, call it 3,925 or so. Getting back above there, getting back above the previous highs. That would tell me to not be as negative as I've probably been feeling right now. But overall, I still feel the weakness in technology has more to go, and it's hard for me to think of the market going up materially with things like semiconductors struggling, as they certainly are again today. But having said that, again, focus on the message of the chart itself. It's now, testing its previous swing high, breaking above trend line. That's certainly a thumbs up. Testing a previous swing high is good. If it's able to do that, it's not just the S&P that's doing better, but it's a lot of individual stocks. And when I'm looking at random stock, looking at energy stocks and others, Viacom and others, these are stocks that are continuing to go to new highs. Not worried about the market, quote unquote, what the market is doing. They're just in uptrends, and in general, following uptrends and leaning into uptrends and leaning away from downtrends is the general discipline that we've been talking about here. So, if we get materially higher than here, and again, for me, I think as long as we remain above that mid-February high. I still think it's safe to assume there's more backing and filling that needs to happen. Long term, I would argue, I certainly think we have much higher that we could go for the equity markets. But I would be amazed and certainly caught off guard if we would materially go much higher than this. It's a question of if we go a little bit higher or a lot lower, in my opinion. And there's enough of a risk of a lot lower that I want to be paying attention to lines in the sand. If and when we do turn back over, which again, I would not be surprised to see, we have broken all of those or checked off all of the boxes except a close below the January low around 3,700. Once that happens, I think you will find a lot more selling that potentially enters it, because that's an indication that the market is rolling to a new swing low, really getting below some of these previous lows, and then it's making a lower high and a lower low, and that's a confirmed downtrend. Right now, we're sort of in a holding pattern. It's about what it feels like. Again, depending on what chart you look at, things look pretty good, or they look pretty challenged. Let's see. One next chart I wanted to show you is this, a chart of semiconductors. When we talk about the weakness in some of these technology spaces, semis closed down about 2% today, so it's not the end of the world. And again, this chart is not horribly broken yet. So please don't assume that that's what I'm suggesting here. But for me, I feel like months, if not years from now, when you look back at this period and you look for tells in the market, the bearish divergence in semiconductors may be the most obvious. And as I've mentioned before, I think this either works beautifully and you get this incredible validation for an indication of exhaustion of buyers, which is what we saw here in December, January, February, going into the February 2020 high. We're seeing a similar pattern here with the market moving to a new high, but the momentum coming out of it. Or this fails and semiconductors go to a new high, and it's an indication that the euphoria is not dissipated yet. There is enough optimism still in equities to push this sort of this group higher. The fact that we've broken down through the January low, and I think that's important to know. The S&P has not, it's held above it. But if you look at the NASDAQ, if you look at semiconductors, you're finding indexes and stocks that are breaking below their swing lows. The FANG stocks would be the other group to watch them. They either have done that or they're right about bouncing around those levels where you're getting a valid breakdown indicating at least an increased risk of further downside potential. So semiconductors, I think, are a really important group to watch. At this point, they have bounced off for a little bit, bounced so far off of the RSI 40 level. That is still, could be arguably a bull market thing. The fact that it's broken down through the 50-day and broken down through the January low, though, I think tells me the path of least resistance is down. We'll have to see what happens next, but I think that's a very important chart to watch. Just to finish off very quickly, and then we need to take a quick break. In terms of what worked today, you'll see a lot of industrials in the top group. Home construction, this would be things like home builders, also things like Home Depot and Lowe's would be related to that in some ways. Aerospace as well. So if you look at the chart of Boeing, and again, having moved to the Seattle area, Boeing is one of those charts I tend to refer to. Nice little breakout. These are, stocks in these sectors are breaking above some key resistance levels worth paying attention to. But then with all of that industrials and everything, gambling stocks in the top 10 as well. So as always, I would pay attention less to what should work and focus on what is working. Let's take a quick